My coach told me I can deduct my skincare, makeup, and nails because I need to look good on social media.
My head hurts.
Ooh. Ooh. Don't forget the Botox.
Any business can have a car 100% deductible.
Ooh.
No, you took mine. You took mine.
And I just got this. Brand new client, sweetheart. We just have to work through it all.
Hey everyone, welcome back to Keep What You Earn. I'm really excited because we have a special episode today. I have an entire party here with me. I have 3 guests all at the same time. We're going to give this a try. And some folks that are familiar faces or voices, I guess, on the show. And I'm going to let everyone kind of introduce themselves, and then I'm going to dive into what the hell this episode is for. So really quick, we've got a lot of women accounting professionals here, which I'm excited about. All friends of mine. We met mostly through Instagram, go figure. But I want to introduce everyone to Caitlynn, Jessica, and Jenni. Hi, guys. Caitlynn, let's start with you.
Hey, so I'm Caitlynn. I've been a CPA for the last 12 years, started working Big Four, think about like the high net worth individuals, moved into corporate tax, and for the last 5 years, I've been serving small businesses in a fractional CFO capacity, so bookkeeping, tax, advisory, all the good stuff.
Awesome. Jessica, welcome back.
Hey, thanks for having me back. So hi everyone, I'm Jessica Smith. Everyone kind of knows me online as Tax Savvy Jessica. I'm an enrolled agent and have been in the industry now for about 12 years. My focus is on tax resolution, so audits, unpaid taxes, all the like. I've been doing that for quite a long time. And it's been a wild ride. I've seen some crazy stuff, so I'm excited to dive into our topics today.
Awesome. And Jenni.
Hi, I have been in the business, I guess, for about 10 years, been doing taxes for the most part. I'm a CPA and been helping small businesses for the last 5 to 6 years, really helping them save on taxes and then also on the fractional CFO side.
Awesome. I just did a little bit of the math in my head, and we have, I think, north of 40 years of experience across this group. So this is really exciting. We have CPAs, EAs, experts, and what we're going to talk about today are a few, what I'll call tax myths. I actually called this episode Tax in the City because I think I'm funny. And I was like, we're going to have 4 women basically over lunch. You're going to be a fly on the wall listening to us kind of talking about common things we hear right now on social media and in the market from clients and from others. And you're going to get the perspective of each person. You're going to get a mixed perspective. You're going to be able to hear that conversation that's happening. So the first thing I want to do is I'm just going to say one thing, and I'm going to let you guys react to this, which is I'm seeing a ton of content right now that's talking about, number one, the IRS is weaponizing 87,000 auditors that are coming to audit your tax return. And I wish eye rolls made a noise because that's what just happened.
Oh, boy.
Ladies, take it away.
I can just see Jessica breathing over there.
Yeah, Jessica, go for it.
Oh my gosh. Okay, so this is like a huge, huge issue, specifically in the space where there's a lot of people who do IRS representation, because those of us who are legitimate, who do this for a living, we really hate fear-based marketing. And I'm telling you, when you have enough people who come to you and are at the lowest point in their life, and they're like, I'm really fearful, I'm going to go to jail if I get audited, if I don't pay these taxes, if I do something wrong, something's going to happen. And it's a really awful thing to experience. And I've experienced it on many, many extremes. So, jokingly, yes, the IRS is going to be hiring more employees, not necessarily auditors. And I believe that like $87,000 number isn't like an actual number. It was a number that somebody took the budget that was presented of what the IRS was going to get for this new act that passed. And then they extrapolated what they believe the salaries would be and then came up with this number. Because 87,000 is like a really weird number if you think about it. So
Yeah.
it's the number of employees, IRS employees, over a period of 10 years. This is not going to happen even in the next, like, it's not going to happen tomorrow. It's not going to happen the next 2, 3, 4, 5 years. This will be over 10 years. We have agents and employees that are retiring. Those people replace those. But these people are not auditors. They're going to be a mix of revenue officers who are people who do collections, uh, agents over the phone to just handle customer service calls and answer questions for taxpayers. So all those calls that nobody can get through, it's going to resolve that. Yes, there will be revenue agents who do more like on-site audit work, and even some criminal, agents that are going to be on the workforce there. But gosh, this idea that you've got this like army of agents coming after you is it's not true. The audit rate is actually, they do not expect the audit rate to increase. They expect the audit rate to remain consistent, but that they're actually going to be able to close their cases and not have these cases drag on for years. They will close them in a reasonable time and not drag this on for 3 years or more.
Well, there you go. That makes total sense.
Yeah, and let's not forget IT employees are a huge part of this too.
Yes.
Like,
Yeah.
we've got 60s technology at the IRS that needs
Fax
to be
machines.
upgraded, so they've got to hire IT folks. Right, we all still fax.
Yeah. You guys don't understand. They're in like the 1980s of technology, and we have to fax the IRS. I mean, they need to implement AI. They need to implement technology. And what Jessica just said, like the 87,000 people is if it went completely to humans as well, right? Because
Yeah.
and what I heard, and tell me if you guys heard anything differently, is that the IRS, after they got this Inflation Reduction Act approved, after that, the IRS was asked, so what do you plan to do with the money? So like they didn't even present a proposal for the money. I think they had to present a budget after the fact. And now they have to figure out how they're going to spend it. So all of this is just kind of, speculation at this point, it feels.
Yeah, for sure. And I think that everybody's just like so fearful. Like, I don't know if y'all have clients come to you that are like, I'm going to go to jail. And I'm like, you're not going to jail. Like,
It's
just
sad,
relax.
really. It
Yeah.
is.
Mhm.
Yes.
Yeah. And for those of you like, you're not going to jail. It's not going to like there's and I always ask, why would you go to jail? And then they say, I don't know.
They don't know.
And that's not, and I don't know. And that's not like, that's not a judgmental thing. That's actually a sign of like, there's a deep rooted fear that is irrational, right? Like
Mhm.
there's a fear. I'm like, well, why is that fear there? Like, can we unpack that? Because what are you worried about? And even if you got, and here's the other thing too, let's just unpack this layer. And Jessica, maybe you have some insights on this, but even if you get audited, that doesn't mean anything bad, right?
Exactly. As someone who's represented like 2,000 people, and that's not an exaggeration, I worked for a law firm, high volume representation only. I would have like 12 new cases like every single day. It was crazy. We had audits all the time that were just, hey, this looks suspicious. We just want to double check. And we were able to prove that the information was correct. No change, right? So there's no balance due, there's no penalty, there's nothing. Yes, you do have to pay for the representation, which kind of sucks. But at the end of the day, those people walked away as whole as they were when they first came there. And the IRS doesn't like put you on some magic little roster like, oh, well, we audited you once before. Now we're going to try to audit you again and win. That's just not how it works. So the idea that all audits come from this position of like, oh, you must have done something wrong is almost entirely false. And the people who do the really wrong stuff, they don't necessarily just get audited. I have seen people who are doing really, really bad things and they don't typically get audited right away because usually they're going to get criminally prosecuted. The really, really bad guys, right? They have to build their case. They cannot just go in once and possibly blow their entire, case with the possibility that this audit is going to produce the evidence that they want. So you're not going to see, your Joe Schmo down the street who just probably forgot to report $10,000 of income getting hammered to the wall for that. The IRS is actually a very, very forgiving agency.
Mhm.
Yeah. And yeah, they really are. And they're pretty flexible. They're all human. I want to actually, excuse me, I want to actually pivot for a second and present this to the group because on that note, right, the only times you really have to worry about getting audited is if you're doing something that is suspicious or egregious or something that's really pushing the boundaries of the tax law, because if you're working within it, you have nothing to worry about. And one of the things that comes up all the time is tax deductions and like where to kind of play in the gray and where to kind of, be more conservative. What are your takes on some of the deductions that are, I guess, quote unquote, riskier? So if somebody came to you and said, what tax deductions might be red flags for an audit or red flags for something bad later? What is your typical advice to your clients and to folks who reach out to you about that?
I would say probably the extreme. So anything on the extreme side. So if your income is like 100K and you're spending $10,000 on meals and entertainment, it's probably like, oh, hmm. Or years and years of like doing negative income or not doing your reasonable salary is a huge one if you're an S corp. So I would say the extreme. So overspending in certain categories or where your income is low.
I come from a different, so I spent a good amount of time in corporate. And so for us, it was unique because we spent so much time analyzing the more likely than not. So we would take a position. So you look at the law and you say, can I do this? And then you would take the position, is it more likely than not I would win? And therefore I could
Mhm.
take this on my return. So that's often the filter that's going through my head is if I read the law, are you more likely than not going to win this? And so I don't know. It's a different look that I have in terms of the extremes, but I'm with Jenni. It's you can also boil it down to some percentages. Like, do your percentages make sense? Are they reasonable for that kind of business across other businesses? Which is why folks will often ask, like, do you understand this industry? Because that will help guide those percentages.
And I absolutely agree with that because with my experience with audits, people are audited for a number of different reasons. A lot of it, though, will boil down to specifically on the individual side, as Jenni mentioned, lifestyle. If you live in San Diego, and this happened to a client of mine, if you live in San Diego and you pay mortgage on a home, the IRS is able to see the amount of mortgage interest, extrapolate that to what the mortgage should be, and compare that to the income on your tax return to see if it makes sense that the income you're reporting can pay that mortgage. Same thing for if you, and I'm using San Diego because that's where I lived for so long. Let's say you lived in San Diego and you had a child and a home. Again, this is a client that I had this with happen. He had a Schedule C business, had written off a lot of stuff. Most of it, honestly, was estimates. You never want to file a return where all of the numbers are estimated. Think of like round even zeros or everything ends in a 0 or a 5. Those are the computer picks those up and they know you're estimating. They want real numbers. So he had a lot of estimated numbers. He had a huge amount of income that was written off on the Schedule C. And then he also had Schedule A deductions, basically putting him into a negative AGI, which made no sense because he had a home that was worth $1 million and a child, and he was living in San Diego with no income. So he got audited, and they went back, I think, like 3 or 4 years and found a lot of stuff that they disallowed. So lifestyle and what you claim on your return, like there has to be a reality, in alignment with reality. And then also to Jenni's point, like looking at the comparison of the expense relative to the income. I do that all the time. The IRS uses like what they call like a diff score. And so they'll compare, a return in an industry for like, 100 different people in the same industry, in the same like radius of area with the same income level. And they're trying to find anomalies. So if one person, let's say, has a marketing budget that is 70% of their income, and marketing is not one of those expense items that is unusual to be really high. But if you run at 70% and everyone else is at 40, you will more likely to be audited because your marketing budget is high and they're going to wonder, why do you need to spend 70% of your budget on advertising to make the amount of money when everyone else is only spending 40?
That's a really good point too. And the way I phrase it and the way I've mentioned it on the podcast before is, does the story make sense? Like, does the story all line up? Do all the facts and circumstances add up to, oh, that makes sense? As soon as there's a deviation or an anomaly or an outlier, like as a former auditor myself, I didn't work for the IRS, but I have an auditor's brain. And I go, anytime I go, huh, that's not a good thing. Anytime you make the auditor go, that's usually a sign that there's something out of alignment that they're going to want to investigate. It doesn't mean there's something wrong. It just means that they have a question. And the more questions they have, the more confused they get, the longer that can, and the more painful an audit could be, depending on what the outcome is going to be. Now, I have one other statement that kind of piggybacks off of that I just want you guys to react to, and feel free to just jump in. One of my favorite sentences. My coach told me I can deduct my skincare, makeup, and nails because I need to look good on social media.
My head hurts.
Ooh. Ooh. Don't forget the Botox.
There's so many elements to that. First of all, my coach told me that I can deduct all this stuff because I need to look good on social media.
It's even like you can extrapolate it. My coach's CPA told them that they can do this. Well, they're not your CPA. Don't take advice from your coach.
So
That's why you hire.
Don't take
help.
tax advice from your coach.
Yes.
No. And I'm sorry. Filters. If you need to look good, go to some of these other influencers. Filters, many of them are free. Okay. And I'm being serious. If I were to approach an audit and my client came to me and said, oh, I'm an influencer, I'm always on camera, I must look my absolute best all the time. Why don't you use a filter like everyone else? And if you are using filters in addition to the great skincare, how can you justify writing off your skincare to look good if the filter is doing the exact same thing? And I've said this before because I believe this would be a position an auditor would take. Especially if you are saying that, oh, well, my Botox and my skincare and my nails and hair, all these things to make me look good, that could be a very significant part of your budget. Those things are not cheap. I mean, I think one of my friends had posted that, oh, the $100 you're sending your girlfriend doesn't even compare like what we actually have to spend to maintain ourselves. Hair is $400 and nails are $70 and, waxing is $100. It's not a cheap thing. And because there are personal benefits to that beyond just that short period of time that you're on camera, you are probably not going to win that argument.
Agreed.
No,
Yeah.
for sure not. I think that's a 2-point situation. It's like the tax deduction and then who to take advice from. Like, and saving on taxes is not your number one game. Like there are
What do you mean
other
by
things
that, Jenni?
to grow your business. You can get more revenue and saving on taxes, yes, save on taxes where you can, but like don't go over and beyond just as like if your number one focus is to save taxes as a business owner, you're probably focusing on the wrong thing.
Well, yeah, then you can spend all your money, not pay taxes, but not make a profit.
Or build wealth.
And then maybe become a hobby.
Yeah, exactly. It would be a hobby. And the other point I would make on top of that is the way I phrase it to clients is let's not walk over dollars to chase pennies, right? So if we're going to obsess over a strategy where you want to deduct your nails, like there's so many better things we can do and win than that. Like that is going to be a battle that I don't think is worth fighting most of the time because most of the time the costs are relatively low compared to bigger expenses. So my advice is usually let's not walk over dollars to pick up pennies. Let's go after some of the bigger ticket things where we can really document, we can really support, and we can back up like the tax strategies we talk about, like the Augusta rule and accountable plan stuff. And like, let's focus on getting that right and really doing that well. Because a lot of the times these expenses, even though they might be minor and little and you can kind of sneak them in, they're really not going to pay off in the long run.
It's not always a 1-for-1. And I think people keep forgetting that like a dollar spent is not always a dollar saved in taxes. It's your tax rate. So if you're just losing money to save 25 cents, like why? Like, let's invest it. Let's look at these other options that are going to benefit future you. And not chase these little facials and nails and stuff.
Yeah, exactly. Here's another sentence. This is the one I'm gonna end with. I heard if I get an LLC, it'll save me money in taxes.
No, it will not.
Ooh.
I don't understand. Like that one, I haven't drilled down to like where did this spin from? A lawyer, maybe? Like I'm trying to figure
Oh,
out
it was
who started this
absolutely a
rumor.
lawyer. It was absolutely a lawyer.
It's gotta
Shout
be,
out to all my
right?
lawyers out there. We love you.
They're selling their service. Oh, an LLC will definitely save you in taxes. Let me charge you $3,000 to set that up for you. And then you go to your tax person, you're like, yeah, no.
No, you can stay a sole proprietorship and deduct it all on your Schedule C, and you have no have the documentation, run the business how it's supposed to be run, and you get to like save on the fees. And these days, any good lawyer, and this is what I tell clients, can pierce that corporate veil of an LLC in no time flat. Like if they're gonna sue you, they're gonna sue you. Bulk up on the insurance. The LLC, as we all know, is helpful for the S corp later down the road, but in California, especially, they're so expensive to have and to keep up. And I just don't understand it, except that a lawyer decided to market it.
For sure. I would completely agree with that.
Yeah. And the other thing I think is, people do have this like false sense of, like you mentioned, Caitlin, that it has this, legal liability separation. That doesn't prevent you from being sued. And like you said, any lawyer, especially these people who operate these single member LLCs, you are the business. Like legally you're separate, but if you are found, negligent, you're still going to be somehow personally liable to some extent. And the reality is these very basic LLC structures are not even in compliance to provide the proper protections. But also, the people who really have LLCs formed for like their asset protection or separation of legal liability have so much more complex legal structures than just, oh, I formed an LLC. They have trusts and they have, other entities, and stuff just kind of like flows kind of down the line. And certain LLCs hold certain assets and certain trusts hold other things. And it's a whole web of things. It's not just like, oh, well, I'm a LLC now, so no one can touch me. And that's just not the case.
It's cheaper to get good insurance a lot of the time.
Yeah.
Like
Oh,
good business
absolutely.
liability insurance. Save up your
Yeah.
deductible, get an umbrella if you really need to. But I mean, I don't, in the structures you're talking about, Chess, like when I was working with high net worth individuals, we're talking people with 200, 300, $400 million that they're needing to protect. That it becomes worth it to pay the experts to structure yourself this way. A couple
And they pay a lot
$100,000,
of
you're
money
better
for
with
that
insurance.
structure.
Mm-hmm.
They
Because it
do.
costs to maintain it.
Yeah. Millions of dollars I've seen clients pay for that.
Oh yeah.
What do you guys think of the argument? Because this is something that I truly feel too. Because like I agree with you guys, but I'm also thinking, well, I like the idea of duration in business and starting that birthday sooner for the business if they want to get a loan or they want to get credit. I feel like it's a good look to set up the LLC sooner. But tell me, do you guys see an advantage or disadvantage to that?
I like to set on the front end. Um, just just because I think it does do a little bit. I mean, there is a little bit of a barrier, but also like getting your checking account, you're not having to redo things. And then if you're really going into business, you're probably going into business to make some money and hopefully more of it than less of it. So if we're already set up that way, then we can make more strategic decisions on the back end, um, to change over to an S corp or do different things that can help the business in the long run.
Yeah, I agree. I think that what I'm taking away from this is like there are good and bad reasons to get an LLC, but I think that a lot of folks choose bad reasons without
Mm-hmm.
realizing it. And they'll go, oh, it's because so and so told me it'll save money in taxes. No, that's not true. An LLC may still be a good idea for you, but it's not for that reason. So it's really having to unpack the good reasons to get one versus the not so great reasons to get one, or the ones that aren't really, they have no foundation, right, to prove that, well, that's not really a benefit of an LLC. And just to be clear, tell our listeners, if you have an LLC or you don't, can you still deduct your business expenses?
Yes.
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 Perfect. And and our favorite thing is and separate that business bank account. I think that's more important. If you have an LLC, but you have a commingled bank account, I would much rather you
Okay.
not have an LLC and have a separate bank account. That's going to do you much better. And it's actually a lot cheaper and easier.
Right.
Correct.
And it's such a state thing. Some states it's $25 to run an LLC and some it's 800. So, I mean, really check the state level when you're looking at this.
Oh, for sure. For
And
sure.
long-term goals.
Mhm.
And don't form an LLC in a state where you don't live.
Yeah.
Yes.
Delaware?
Yeah,
I
you
hate
can do
those.
that.
I hate those.
But I just had this question come up in my DMs about this. It comes up a lot actually. And there's nothing wrong with doing it, but it's going to be a lot of extra time, energy, and money, in my opinion, to do that because you have to set up as a foreign entity where you actually live. You can't just like pretend, you can't disappear. You can't pretend you live in another state. So you pay taxes where you live. If you want to register an LLC in another state, that cool, but you're going to pay fees in that state and the one that you're in. So I don't see a lot of scenarios where you win by doing it that way. But I don't know if there's any other benefits that you guys know about.
People will say that organizing in Delaware just has better privacy laws, which could be true. I don't know, but I think a lot of people are under the impression that if you organize in a state with no income tax, that magically there's no income tax on that. And I'm going to use California as an example because California is extremely aggressive. If you have a California address on anything tax wise, a 1099, a W-2, you get a K-1 from an LLC and you're shown as like 100% shareholder or it's a significant amount of income where it would be required to be reported in California. They get all that from the IRS. The IRS actually shares all the federal information with the states based off the address that is filed on the return. So if you get a notice from a state saying that, oh, we think you are required to pay, taxes to our state, it's probably because they got the information from the IRS. And those records sometimes take a year or more to kind of catch up on. So if you are organized in Delaware, but you live in California and you never formally register your business in California, pay their required franchise fees, they're going to find you. They're going to assess the tax plus penalties and interest. So you're talking what would be an $800 liability is now $1,600 or more simply because you thought that you would get away with not having to pay the tax because you organized in Delaware. And then Delaware also has some of their own taxes. So if you don't maintain those entity taxes, because I just had this experience with another client, partnerships and like certain LLC, single member LLCs are subject to certain taxes in the state of Delaware. So if you don't know that, or you're thinking, oh, well, there's just no income tax in Delaware. Yeah, there is. And they'll cancel your entity until those are paid. So, really, really, what are you doing aside from just making things a lot more complicated for yourself? That's why we all say meet with an attorney and a tax person, because I always say sometimes you're going to have to prioritize one or the other, right? You're either going to prioritize the legal aspects of the entity and maybe lose out on some of the tax benefits, or maybe you'll sacrifice some of the legal stuff to take advantage of the tax stuff. It's not always like that they're, mutually exclusive, I guess. But always meet with both because you might get a different opinion. And I'm sorry, the tax stuff sometimes comes to a head a little bit faster than legal stuff.
That's true.
We deal with it
So-
in the military community all the time because people are
Oh
moving.
my
So
gosh.
you have your home base, you have your foreigns. I mean, I had to do it. It sucks. Whenever you can just get to one state, your life is just so much easier.
I can imagine. So I want to go around as we're kind of tying things up. And are there any other tax myths that you're hearing that are like throw one out there that's like one of your favorites or one that's like coming through your questions a lot? And keep in mind too, and like you guys think about this as I kind of go, I have to explain this one that if you're asking questions, if you're in my DMs, if you're in our community and you're asking these types of questions, these are all very welcome questions. All the stuff that we're hearing is grounded in all of these like misconceptions, but that's not your fault because you're hearing a lot of this stuff, you're consuming it. And what we're trying to do is dispel some of that and really break it down to no, here's like the real deal on how it works. We're not here to apply any judgment, any shame, or tell you you're wrong. What we're here to do is say, this is our perspective on it, but also like, please send us your questions, keep us engaged, and like, stay educated on this stuff, because just because someone famous and went viral and said that thing doesn't mean it's true. We really have to be focused on, well, what is really, what is correct? What is good advice for me? And you have to choose what you consume. Uh, just going around, who wants to go first and name anything you can think of that's a fun tax myth to bust? Caitlin?
That any business can have a car 100% deductible.
No, you took
Ooh.
mine. You took mine.
And I just got this. Brand new client, sweetheart. We just have to work through it all. Just got this. Can I buy this car with my business? She's mostly online. And it's just the lack of understanding. But yeah.
And that's the thing. Well, you know what it is? There's so much content saying you can do that.
Yep, there is.
There's
and
so much.
It's not her fault. It's just not. Somebody told her that this was a great idea. And that's, like you said, it's the education part. There's no judgment. Thank you for asking. Now let's walk through that. A realtor can do it because a realtor spends 90% of their time driving around in their car. But you, who works from home like I do, really can't justify it. Let's just do a mileage accountable plan. And
Yeah, I think
we'll
it's
get
just
you the deduction
interesting.
that way.
Definitely. What else do you guys have for that's a really good one. I love that one. My favorites, I always talk about the G-Wagon. That's my favorite.
Yes.
Is like I can deduct a G-Wagon.
I want to elaborate a little bit on like what Caitlin mentioned in the whole like, oh, I can write off my car, right? Aside from the fact that there are people who are online who think that having a car for their business somehow just makes it, oh, it's for business. Oh, okay, well, it's a business expense. You can't just say, and then it just magically becomes. In every audit that I have ever been in where automobile expenses come into question, and they come into question most of the time, if you cannot present to the auditor an original mileage log, not a recreated one, if you cannot present them with an original mileage log, regardless of the method that you choose to take auto expenses, you absolutely have to have a mileage log. That's just the rule. There's no way around it. All your auto expenses will be thrown out. Because the purpose of that mileage log is to substantiate, for one, how often the car is actually being used, but also how often the car is being used exclusively for business purposes. So if you roll in with your G-Wagon and because it's over 6,000 gross vehicular weight, you can now Section 179 it, and you don't have any proof that that vehicle was used in your business to meet the requirements, 50% or more, right? Then you're not going to win. And on another note, those of you who have entities organized as S corporations that put those vehicles into your S corporation, if you put it in the S corporation and let's say maybe you do meet that over 50% use, as soon as it drops to under, it's a conversion to personal property and it's considered a sale at fair market value. Now you have a gain that you have to report on your tax return. Why not just leave it as a personal asset, take a mileage deduction through an accountable plan if possible, and avoid the whole having to even include it on a reporting of a gain upon the sale or conversion from business to personal property. There's lots of tax consequences that nobody thinks about when they say, oh, I just want to write off a car. And Section 179 is great, but I would never tell someone take Section 179 if they are, let's say, a realtor, because they'll use up all of those deductions in that 1 year. And that's it. When you take depreciation, you can't take anything else at that point. You're done. So you've lost out on all those future deductions for mileage down the line, because you can't take mileage after you've depreciated a car in full. That's just the rule. And it's not a simple, here's how we take it. It's nuanced. Vehicle expenses are very, very nuanced. There's a ton of stuff even having to do with, people who have considered fleets of vehicles. It's not a one size all approach, but the G-Wagon
Oh,
one
yeah.
is my favorite. Online business coaches who
Oh,
want to
totally.
write off their G-Wagon, and half their listeners
And
can't
business
even
insurance on a
afford it.
car?
Oh,
Yeah.
Right. Well, and business insurance on a car is so much more expensive than your personal insurance on a car. So
mhm,
that's the thing. If you're titling it under the LLC and stuff, it's so much more expensive because they're protecting in case your employer or something gets in an accident. Um, so yeah, I don't know. I like the mileage. And if you talk to like the really old accountants who have seen years of this, they'll say the mileage long term works out pretty good for you. So
mhm.
just stick with that.
Yeah. Or actual cost method and doing accountable plan, I think is my number one choice, especially right now because gas is so freaking expensive that the mileage rate, even when they increased it, I'm like, eh. Like they're spending more money on their vehicles right now. And it's going to be really interesting. I'm actually intrigued to see like with the electrical vehicles that are coming out, going, okay, like gas and fuel, does that mean I get like part of my electric bill? Am I going to get like how's that going to work in the future? Is the mileage rate going to be for an electric vehicle and a gas powered vehicle? Who knows, right? This is the stuff that goes through our heads, by the way, like all of us nerds. Like this is the stuff that we think about. Jenni, you were going to say another myth, I believe, or chime in
I don't
there.
have a myth, but I have a suggestion. I think
Yeah.
that when you're looking for a tax preparer, tax planner, tax strategist, I think don't just go with whoever your neighbor uses. I would interview a couple and then also want to make sure that you're meeting with that person more than one time a year. If you have a business especially, but like just making sure that you have a good match and understanding the risk and the rewards on every scenario, I
Oh
think
my
would be
God,
my,
totally.
yeah.
Mhm.
Yeah. You know what it is? The number one thing when folks ask me, and I mentioned this in one of our episodes in the past, was what should I look for in a tax preparer? My number one thing is matching risk tolerance. That's my number one, is like find someone who takes a similar approach. And you know what's interesting is everyone in this virtual room right now, everyone on this podcast has a different risk tolerance in different areas of their business. I was just on the phone with someone earlier this week. It could have been one of you. I don't even remember now. We chat all the time, and it will be like, "Hey, how do you approach this?" Oh, I was talking with one of my friends who's a bookkeeper, and she was asking about meals, for example. And she's like, well, how do you look at receipts? And I said, well, here's kind of my give a what threshold on that. Like, how much, like, are we really militant about it? Or are we like, here's the reality of what you can expect, and here's what I'm willing to be flexible on? There's a certain amount of risk tolerance all of us have based on our own experience and our own perspective. And what people don't realize is that the tax law is not always black and white. There is a bit of a gray area, and there is a bit of a what actually makes sense in practicality approach. And you have to really use your judgment. And that's why having a professional who matches your approach is so powerful, because then you're in agreement on the approach and you can defend it. And then there's an understanding there. But if you have a completely different viewpoint on it, it can cause a really, really difficult relationship and difficult tax situation with the IRS and state agencies.
Agreed.
Completely
Yeah.
agree.
Absolutely
And
agree.
documentation. If you want to
Mhm.
take the deduction,
Mhm.
you got to put the effort in.
Yeah.
With great savings comes great responsibility. All the time. Ladies, thank you so much for hopping
Thank
on the
you.
show. I really appreciate it. I love these conversations. I have the pleasure of talking with each of you separately and together sometimes. And it's just so great to have other people in your industry who kind of have a similar approach, who get it, who understand entrepreneurs, who are, in this digital space and know what these things are, know how to apply the tax law in a 2022 world. And I'm super grateful to have you guys as professionals to bounce stuff off of. And our listeners, thank you so much for joining us and hearing from all these folks. Make sure you're following them on social media. The links are in the show notes. Make sure that you are looking for a professional that matches your risk tolerance, your personality, and what you want for communication. That is so powerful. And these three are great examples of what you can look forward to working with if you put the time in to look for a professional that makes sense for you. All right. Thank you all for joining us, and we'll catch you on the next episode.